I am going to tell you something that Wall Street does not want you to hear. The investment products that millions of Americans have been told are safe, diversified, and perfect for long-term investing are hiding risks that could devastate portfolios when the next crisis hits. I am talking about ETFs, exchange-traded funds, the products that have become the default investment vehicle for an entire generation of investors. Everyone thinks they understand ETFs. You buy a fund, you get instant diversification, you pay low fees, and you can trade it anytime the market is open. It sounds perfect. It sounds too good to be true. And in some cases, it is too good to be true. Because underneath the simple marketing pitch, there are structural problems that most investors never think about until it is too late. Before you dismiss this as fear-mongering, let me remind you of my track record. I saw the 2008 housing crisis coming years before it happened. I bet against mortgage-backed securities when everyone on Wall Street was telling me I was crazy. I made hundreds of millions of dollars for my investors by recognizing risks that the crowd refused to see. I am not always right, but when I see a structural problem building in the financial system, I speak up. And right now, I see massive structural problems in the ETF market that almost nobody is talking about. The ETF industry has exploded from a few $100 billion in assets 20 years ago to over $10 trillion today. $10 trillion. That money has flooded into products that most investors do not truly understand. They see low fees, they see diversification, they see convenience, and they assume everything is fine. But underneath the surface, there are risks building that could turn these supposedly safe investments into weapons of wealth destruction. Today I'm going to walk you through 5 popular types of ETFs that are hiding massive risks. I'm going to explain exactly what those risks are, why they matter, and what could trigger a crisis. This is not about scaring you out of investing. This is about making sure you understand what you actually own so you can make informed decisions about your financial future. Let me start with a fundamental problem that affects almost all ETFs, but that very few investors understand. It is called the liquidity mismatch problem, and it is the dirty secret of the ETF industry. Here is how ETFs are supposed to work. You buy shares of an ETF on the stock exchange just like you would buy shares of any company. The ETF holds a basket of underlying securities, stocks, or bonds, or commodities, or whatever the fund is designed to track. The price of the ETF should closely track the value of those underlying holdings. If the ETF price drifts away from the underlying value, authorized participants step in to arbitrage the difference, buying or selling the underlying securities to bring the price back in line. This mechanism works beautifully in normal times with liquid underlying assets, but it breaks down catastrophically when the underlying assets are illiquid or when market stress causes the arbitrage mechanism to fail. And many of the most popular ETFs hold assets that could become extremely illiquid exactly when investors most need to sell. Think about what happens during a market panic. Everyone wants to sell at the same time. In a traditional mutual fund, redemptions happen at end-of-day prices, giving the fund manager time to sell underlying holdings in an orderly fashion. But ETFs trade continuously throughout the day. When panic selling hits an ETF, the price can collapse far below the value of the underlying holdings because there is no one willing to step in and arbitrage the difference. We saw this happen in August 2015 when ETFs traded at discounts of 20 or 30% to their underlying values. We saw it happen in March 2020 when credit ETFs became completely disconnected from their underlying bond prices. These were not small, obscure funds. These were massive, popular ETFs that millions of investors owned. Now, let me get specific about which ETFs are hiding the biggest risks. The first category of ETFs hiding massive risk is high-yield bond ETFs. These are funds that hold what used to be called junk bonds, corporate debt issued by companies with weak credit ratings and high risk of default. High-yield bond ETFs have become enormously popular because they offer yields of 7, 8, even 9% in a world where safe investments pay much less. Investors desperate for income have poured hundreds of billions of dollars into these products. Here's the problem. The underlying bonds in these ETFs are extremely illiquid. Corporate bonds do not trade on exchanges like stocks do. They trade over-the-counter, dealer to dealer, with wide bid-ask spreads and limited transaction volume. On a normal day, Many of the bonds in a high-yield ETF might not trade at all. The prices you see are often just estimates based on models rather than actual transaction prices. Now, imagine what happens when the economy turns down and investors start worrying about corporate defaults. Everyone who owns high-yield bond ETFs decides to sell at the same time. The ETF price starts falling. Authorized participants are supposed to step in and arbitrage the difference by buying the cheap ETF and selling the underlying bonds. But wait, they cannot sell the underlying bonds because there are no buyers. The bond market has frozen. Dealers are not making markets. Liquidity has evaporated. So the authorized participants do not arbitrage. They step back and wait. And the ETF price collapses far below the actual value of the underlying bonds. Investors who thought they owned a diversified bond portfolio suddenly find themselves selling at 50 or 60 or 70 cents on the dollar because the liquidity mismatch has blown up in their faces. This is not theoretical. This is exactly what happened in March 2020. The largest high-yield bond ETF traded at a discount of over 5% to its net asset value for days. Some smaller high-yield ETFs traded at discounts of 10 or 15%. Investors who needed to sell during that period took massive losses that had nothing to do with the actual credit quality of the underlying bonds. They were forced to accept whatever price the market would give them, and the market was giving them terrible prices. I remember watching this unfold in real time. Investors were selling high-yield ETFs at massive discounts because they needed liquidity. Meanwhile, the underlying bonds were not even trading. The net asset values being published were based on models and estimates, not actual transaction prices. Nobody really knew what those bonds were worth because there were no buyers. The entire market had frozen. And here is what really worries me. The high-yield bond market has grown enormously since 2008. Companies have taken advantage of low interest rates to issue mountains of debt. Much of this debt is held in ETFs by investors who have no idea how illiquid their holdings really are. When the next credit crisis hits, and there will be another credit crisis, the high-yield ETF market could experience dislocations that make 2020 look mild. The second category of ETFs hiding massive risk is emerging market bond ETFs. These funds hold debt issued by governments and companies in developing countries. Places like Brazil, Turkey, South Africa, Indonesia, Mexico. They offer even higher yields than high-yield corporate bonds because they carry even more risk, and they have attracted enormous inflows from yield-hungry investors. The liquidity problems with emerging market bonds are even worse than with high-yield corporate bonds. Many of these bonds trade in local markets with limited hours and limited participation. Currency risks add another layer of complexity. When stress hits, emerging market bonds can become almost completely illiquid. But the real risk with emerging market bond ETFs is what I call the crowded exit problem. These ETFs have attracted massive inflows over the past decade as investors reached for yield. The same trade that seemed so smart going in becomes a disaster going out. When everyone owns the same thing and everyone tries to sell at the same time, prices collapse. I have studied previous emerging market crises. The Asian financial crisis in 1997, the Russian default in 1998, the taper tantrum in 2013, the Turkish lira crisis in 2018. Every single time, investors who thought they could get out quickly discovered they could not. The markets froze. Prices gapped down. Losses far exceeded what anyone expected. Now imagine that dynamic playing out in ETFs that trade on American exchanges in real time. Investors see the price collapsing and they panic sell. But the underlying bonds are not trading. There is no price discovery. The ETF becomes completely disconnected from reality. Authorized participants refuse to step in because they cannot hedge their risk. The whole thing becomes a feedback loop of selling and price declines that feeds on itself. If you own emerging market bond ETFs, you need to understand that you own a product that could gap down 20 or 30% in a crisis with no warning and no opportunity to get out at reasonable prices. The yield you are earning does not compensate for that tail risk. The third category of ETFs hiding massive risk is leveraged ETFs. These are funds that use derivatives to deliver 2 times or 3 times the daily return of an underlying index. They have become incredibly popular with retail investors who want to amplify their gains. They look like a way to supercharge your returns. In reality, they are ticking time bombs that destroy wealth over time. Let me explain the math, because this is something that most leveraged ETF investors do not understand at all. Leveraged ETFs are designed to deliver their multiple on a daily basis, not over longer periods. Because of the way daily compounding works, these products experience what is called volatility decay. Even if the underlying index ends up flat over time, a leveraged ETF tracking that index will lose money. Here is a simple example. Say an index starts at 100, falls 10% to 90, then rises 11.1% back to 100. The index is flat. But a 2 times leveraged ETF would fall 20% to 80 on the down day, then rise 22.2% to 97.8 on the up day. Even though the index is flat, the leveraged ETF lost 2.2%. And this decay happens every single day that volatility exists. Over months and years, this decay can be devastating. There have been periods where the underlying index rose, but the leveraged ETF tracking it actually fell because the path was volatile enough to destroy value through daily compounding. Investors who held these products expecting to get 2 or 3 times the long-term return of the index instead got negative returns. The marketing materials for leveraged ETFs technically disclose this risk, buried in the fine print that nobody reads. They say the fund is designed for short-term trading and may not track the underlying index over longer periods. But the reality is that millions of retail investors own these products as long-term holdings because they do not understand the math. I have talked to investors who have held leveraged ETFs for years, thinking they were getting amplified exposure to the market. They had no idea they were losing money to volatility decay every single day. They bought these products because they saw the big numbers, 2 times, 3 times, and thought they were getting a good deal. Instead, they were being slowly bled dry by a mathematical phenomenon they did not understand. One investor I spoke with held a 3 times leveraged NASDAQ ETF for 2 years. During that time, the NASDAQ rose about 15%. He expected his ETF to be up about 45%. Instead, it was up only 8%. He lost almost 40% of his expected return to volatility decay. He was furious when he finally understood what had happened. But the information was in the prospectus the entire time. He just never read it. Another investor held a 2 times leveraged oil ETF during a period when oil was extremely volatile. Oil ended up roughly flat over 6 months, but his ETF lost 30% of its value. 30% lost on an underlying asset that went nowhere. That is the power of volatility decay, and it is working against leveraged ETF holders every single day. And here is the really dangerous part. Leveraged ETFs become even more destructive during periods of high volatility, exactly when markets are most stressed. During the 2020 crash, some leveraged ETFs experienced declines of 90% or more in a matter of weeks. Investors who thought they could ride out the volatility discovered that their funds had been destroyed before the market even bottomed. If you own leveraged ETFs, you need to understand exactly what you own. These are not investments. They are short-term trading instruments that will destroy your wealth if you hold them for extended periods. The math guarantees it. The fourth category of ETFs hiding massive risk is thematic ETFs. These are funds that focus on hot investment themes: clean energy, artificial intelligence, cannabis, blockchain, genomics, space exploration, electric vehicles, cybersecurity. Whatever the trend of the moment is, there is probably an ETF for it. Thematic ETFs have exploded in popularity because they offer a way to bet on the future. Investors who believe in a particular trend can buy a single product and get exposure to dozens of companies in that space. It feels smarter than trying to pick individual winners. And the themes themselves are often genuinely important trends that will shape the economy. So what is the problem? The problem is that thematic ETFs tend to launch at exactly the wrong time and hold exactly the wrong stocks. Here is how the ETF business works. Asset managers watch what is hot in the market. When they see a theme gaining attention, when they see retail investors searching for ways to invest in that theme, they launch an ETF. The launch happens after the theme has already become popular, after the stocks in that theme have already risen dramatically, after the easy money has already been made. Then investors pile into the new ETF, buying at the top. They are buying stocks that have already appreciated enormously on the expectation of future growth. They are paying premium valuations for companies that may or may not actually benefit from the theme. And because the ETF has to buy more stocks as money flows in, it pushes prices even higher, creating a bubble in exactly the stocks it holds. We saw this play out spectacularly with the ARK Innovation ETF and similar thematic funds during 2020 and 2021. Investors poured money into funds focused on disruptive innovation. Those funds bought more and more of a concentrated set of speculative technology stocks. The stocks rose, which attracted more money, which bought more stocks, which rose further. It was a self-reinforcing bubble. Then rates rose, sentiment shifted, and the bubble popped. The ARK Innovation ETF fell over 75% from its peak. The same feedback loop that pushed prices up pushed them down even faster. Investors who bought at the top lost 3/4 of their money on what they thought was a diversified fund. But it was not just ARK. The clean energy ETFs that attracted billions during the green energy boom collapsed when interest rates rose and the economics of renewable projects deteriorated. The cannabis ETFs that launched during the marijuana legalization hype have fallen 80 or 90% from their peaks as the industry has struggled with oversupply and regulatory problems. The blockchain and cryptocurrency-related ETFs that launched during the cryptomania have been devastated as digital asset prices collapsed. The pattern repeats over and over. A theme becomes hot. Wall Street launches ETFs to capture investor interest. Money floods in at the top. The bubble pops. Investors lose enormous amounts of money. Then a new theme emerges and the cycle starts again. I watched the dot-com bubble in 1999 and 2000. The themes were different, internet stocks and telecom, but the psychology was identical. Everyone believed they were investing in the future. Everyone believed valuations did not matter because the opportunity was so big. Everyone bought at the top of the hype cycle, and everyone lost enormous amounts of money when reality caught up with expectations. The problem with thematic ETFs is that they are structurally designed to buy high. They launch when themes are hot. They buy stocks that have already risen. They attract the most money at the worst times. And when the theme fades, there is no floor. The same momentum that drove prices up reverses and drives them into the ground. If you own thematic ETFs, ask yourself honestly when you bought them. Was it after reading headlines about how hot the theme was? Was it after the stocks had already doubled or tripled? If so, you probably bought at the top of a hype cycle. And you may be holding bags that will take years to recover if they ever do. The fifth category of ETFs, hiding massive risk, is broad market index ETFs that have become too big. This might be the most controversial thing I say today because index investing has become almost a religion for a generation of investors. The gospel of passive investing says you should just buy the whole market through a low-cost index fund and hold forever. And there is real wisdom in that approach for most investors. But here is what worries me. The passive investing revolution has pushed an enormous amount of money into a small number of very large index ETFs. The 3 largest S&P 500 ETFs alone hold over $1.5 trillion. When you add in mutual funds tracking the same index, the total is several trillion dollars. This massive concentration of capital in index products is distorting markets in ways that few people appreciate. Index funds do not analyze companies. They do not assess whether stocks are cheap or expensive. They just buy whatever is in the index in proportion to its market cap weight. This means they buy more of stocks that have already gone up and less of stocks that have gone down, regardless of underlying value. The result is a market where prices are increasingly set by mechanical flows rather than fundamental analysis. Active managers who actually analyze companies are becoming a smaller and smaller part of the market. The price discovery function that markets are supposed to provide is being degraded. Here is why this matters for risk. When everyone owns the same thing through index funds, it creates what I call a crowded theater with a narrow exit. As long as money keeps flowing into index funds, everything is fine. Prices are supported, volatility is suppressed. Everyone feels smart. But what happens when the flows reverse? What happens when baby boomers start drawing down their retirement accounts? What happens when a market shock causes investors to panic and sell their index funds? Everyone rushes for the exit at the same time. And the mechanical selling that supported prices on the way up accelerates the decline on the way down. We do not really know how bad this could get because we have never had this much money in passive strategies before. We are running an experiment on the entire financial system in real time. I hope it works out fine. But the size and concentration of passive investing is a structural risk that deserves much more attention than it gets. There is also a more subtle risk with index concentration that affects everyone, not just index fund investors. Because index funds own the largest stocks in proportion to their weight, they have driven up valuations on mega-cap stocks relative to smaller companies. The top 10 stocks in the S&P 500 now represent over 30% of the index, a concentration level not seen since the dot-com bubble. If you own an S&P 500 index fund, you are not getting the diversification you think you are. You are making a concentrated bet on a handful of giant technology companies. If those companies stumble, if their valuations compress, your diversified index fund will get hit hard. Think about what this means in practical terms. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. These 7 companies represent a massive chunk of the entire index. When you buy an S&P 500 fund thinking you are getting exposure to 500 different companies, you are really getting heavily concentrated exposure to these 7. The other 493 companies barely move the needle. This concentration has worked wonderfully during the period when these mega-cap technology stocks have dominated. But what happens if technology leadership fades? What happens if antitrust enforcement breaks up some of these giants? What happens if AI hype fades and Nvidia's valuation collapses? Your diversified index fund will feel a lot less diversified. I am not predicting these things will happen. I am pointing out that the diversification benefit of index funds has been degraded by the extreme concentration at the top of the market. You should own index funds knowing what you actually own, not based on an outdated assumption about 500 equally weighted stocks. Now, let me bring all of this together and explain what I think it means for investors. The ETF industry has been brilliant at marketing simplicity and low costs. Those are real benefits. I am not saying you should never own an ETF. What I am saying is that you need to understand what you actually own. You need to understand the risks that are hidden beneath the surface. And you need to make sure those risks are appropriate for your situation. Most ETF investors have never experienced what happens to these products during a real crisis. They have owned them during a period when central banks were pumping liquidity into markets, when interest rates were falling, when risk appetite was high. They have seen mostly smooth sailing, but smooth sailing does not test the structure of the ship. Storms do. When the next storm comes, and there is always another storm, some ETFs will perform exactly as expected. They will track their underlying indexes, provide the diversification and liquidity that investors expect, and serve their purpose well. But others will break down. The liquidity mismatches will be exposed, the structural flaws will become painfully apparent, and investors who thought they owned something safe will discover they own something dangerous. The high-yield bond ETFs will trade at massive discounts to their underlying values. The emerging market bond ETFs will become untradeable. The leveraged ETFs will destroy whatever capital remains after the initial decline. The thematic ETFs will collapse as hot money flees and the bubble stocks crater. And even the broad market index ETFs may experience dislocations as the sheer weight of passive selling overwhelms the market's ability to absorb it. I am not telling you to sell all your ETFs tomorrow. I am telling you to understand what you own. Read the prospectus. Understand the underlying holdings. Think about what happens in a crisis. Ask yourself whether the risks are appropriate for your situation and your risk tolerance. If you own high yield or emerging market bond ETFs for the yield, ask yourself whether that yield compensates for the tail risk of massive losses in a credit crisis. If you own leveraged ETFs, understand the math of volatility decay and decide whether that product really belongs in your portfolio. If you own thematic ETFs, ask yourself whether you bought at the top of a hype cycle. If you own concentrated index funds, understand that you are making a bet on a handful of mega-cap stocks, not a broadly diversified portfolio. The ETF industry does not want you to think about these things. They want you to see low fees and diversification and stop asking questions. They want you to believe that ETFs are automatically safe because they are funds rather than individual stocks. But a fund that holds risky assets is still risky. A fund that has structural liquidity problems will still have those problems in a crisis. A fund that is designed to decay over time will still decay over time. You are responsible for understanding what you own. Nobody else will do that work for you. The financial advisors pushing these products are often as ignorant about the risks as their clients. The marketing materials are designed to highlight benefits and hide risks. The only way to protect yourself is to do your own homework and think critically about what could go wrong. Let me share some principles for evaluating ETF risk that you can apply to any product you are considering. First, look at the underlying holdings. What assets does the ETF actually own? How liquid are those assets? Could they be sold quickly in a crisis? If the ETF holds illiquid bonds, thinly traded stocks, or complex derivatives, be very cautious about the liquidity risk. Second, look at the ETF's tracking history during stress periods. How did it perform in March 2020? How did it perform in other volatile periods? Did it track its underlying index closely, or did it diverge significantly? Large tracking errors during stress periods are a red flag. Third, understand the fund structure. Is it a physically replicated fund that actually holds the underlying securities, or is it a synthetic fund that uses derivatives to simulate the returns? Synthetic funds add counterparty risk on top of market risk. Fourth, look at the fund size relative to the liquidity of the underlying market. A $10 billion ETF holding illiquid small-cap stocks or emerging market bonds might not be able to liquidate its holdings without moving the market. This creates risks that do not exist in smaller funds or funds holding more liquid assets. Fifth, consider what happens if everyone sells at once. ETFs that have attracted huge inflows during good times can experience even larger outflows during bad times. The crowded exit problem is real, and it affects ETFs that have become too popular. I want to be clear that I am not predicting exactly when or how an ETF crisis will unfold. I do not have a crystal ball. What I am saying is that the structural risks in the ETF market are real, they are growing, and they are being ignored by most investors who own these products. When the crisis comes, there will be plenty of people saying they did not see it coming, that nobody could have predicted it, that it was an unforeseeable black swan. But it is not unforeseeable. The risks are visible right now to anyone willing to look. The question is whether you will look and prepare, or whether you will be caught by surprise like everyone else. I made my reputation by seeing risks that others ignored. I am telling you that the ETF market has risks that others are ignoring. What you do with that information is up to you. But do not say you were not warned. The 5 categories I have discussed today, high-yield bond ETFs, emerging market bond ETFs, leveraged ETFs, thematic ETFs, and oversized index ETFs, are where I see the biggest risks hiding. But the principles apply more broadly. Anytime you buy an investment product, you need to understand not just how it works in good times, but how it might break down in bad times. Investing is not just about returns, it is about risk-adjusted returns. It is about understanding what can go wrong and deciding whether you are being compensated appropriately for those risks. The investors who do that homework will be prepared when the storm comes. The investors who do not will learn some very expensive lessons. I have been called a perma-bear, a pessimist, someone who always sees disaster around the corner. That is not accurate. I am an investor who believes in understanding risk. I am bullish when risks are appropriately priced and bearish when they are not. Right now, in the ETF market, I see risks that are not appropriately priced because most investors do not even know those risks exist. Now you know. The question is, what you will do about it. The history of financial markets is littered with products that seemed safe until they were not. Money market funds that broke the buck. Auction rate securities that froze. Mortgage-backed securities rated AAA that became worthless. In every case, investors were told these products were safe, diversified, low risk. In every case, they were wrong. ETFs might be different. The structure might hold up better than I fear. The liquidity mechanisms might function even in extreme stress. The passive investing revolution might continue indefinitely without consequence. I hope that is the case. But hope is not a strategy. If I am wrong, you will have done some homework and gained some understanding of what you own. That costs you nothing. If I am right, you will be prepared when others are panicking. That could save you everything. The risks are real. The risks are growing. And the risks are hiding in plain sight in some of the most popular investment products in the world. Now you know what to look for. Now you can make informed decisions. And now you cannot say you were not warned.